What if AI was making the decisions back then? What if you could go back in time? Not to change your life, but to change your investments. What if, instead of guessing, following trends, or listening to opinions, you had something purely logical guiding your decisions? Something that doesn't panic, doesn't get greedy, doesn't follow hype. In 2026, we trust AI with almost everything. It analyzes data, predicts patterns, and helps us make smarter decisions. But here's the real question. What if we applied today's AI logic to past market trends? Not to predict the future, but to understand the difference between emotional investing and data-driven decisions. Because hindsight gives us something powerful: clarity. So in this video, we're going to do something different. We're going to look at major moments in the market and break down what AI would have likely done based on logic, data, and historical patterns. And the results might completely change how you think about investing. The human problem: why people make wrong decisions. Before we even talk about AI, we need to understand the real issue. The problem is not the market. The problem is how people behave inside the market. Every major financial mistake in history follows the same pattern. Prices start rising, people get excited, media attention increases, and suddenly, everyone wants in. Not because they understand the asset, but because they don't want to miss out. This is where emotion takes control. Fear of missing out pushes people to buy high. Fear of losing money pushes them to sell low. And this cycle repeats again and again. Across different markets, different assets, and different generations, the market doesn't trick people. People trick themselves. And this is exactly where AI operates differently. Because AI doesn't feel. AI doesn't think the way humans do. It doesn't rely on news headlines, social trends, or emotional reactions. It processes data, identifies patterns, and evaluates probabilities. When AI looks at a market, it doesn't ask, "Is this exciting?" It asks, "Does this make sense based on historical behavior?" It looks at valuation, momentum, volatility, and long-term trends. It compares current conditions with past patterns and identifies similarities. And most importantly, it removes emotion from the equation. That means no panic selling during crashes, no hype-driven buying during peaks, just structured decision-making. But what happens when we apply that logic to real historical events? That's where things get interesting. Let's go back to the late 1990s. The internet was new, exciting, and full of potential. Companies with little to no profit were seeing massive valuations simply because they were part of the future. People believed they were witnessing a revolution, and they were. But they ignored one critical detail: valuation. If AI had analyzed that market, it wouldn't focus on excitement. It would look at fundamentals: revenue, profitability, sustainability, and based on those factors, it would likely identify a disconnect between price and value. While humans were buying aggressively, AI would likely slow down, reduce exposure, or avoid overvalued assets entirely. And when the crash came in 2000, wiping out billions, the difference between emotional investing and data-driven logic became clear. The housing market had been rising for years. Confidence was high. Banks were lending aggressively. People believed real estate prices would keep going up indefinitely. But beneath the surface, risk was building. Debt levels were increasing. Financial products were becoming more complex. And the system was becoming fragile. AI, analyzing historical patterns and risk indicators, would likely detect rising instability. It would recognize patterns similar to previous economic cycles. Instead of increasing exposure, it would likely reduce risk, but humans didn't. They followed the trend, and when the system collapsed, it wasn't just a market drop, it was a global financial crisis. Now let's look at something more recent, the 2020 market crash. When the global pandemic hit, markets dropped rapidly. Fear took over. Investors started selling, expecting long-term damage. But something interesting happened. The market recovered faster than expected. Now here's the key question. What would AI have done? Instead of reacting to fear, AI would analyze past crisis patterns. It would recognize that markets historically recover after major shocks. So instead of panic selling, AI would likely stay invested, or even increase exposure during lower prices. And those who followed that logic benefited from the recovery. This is where the difference becomes clear. Humans react. AI evaluates. The rise of crypto created one of the most emotional markets in recent history. Prices surged rapidly. Social media exploded with success stories, and millions of new investors entered the market, but volatility was extreme. If AI analyzed this space, it wouldn't ignore the opportunity, but it would recognize the risk. It would identify high volatility, lack of regulation, and unpredictable price behavior. Instead of going all in, it would likely control exposure, and when the market corrected, that disciplined approach would protect capital. Looking at all these examples, one pattern becomes clear. The market is not random. Human behavior is predictable. Fear, greed, excitement, panic, these emotions drive most decisions. And these decisions create cycles that repeat over time. AI doesn't eliminate risk, but it removes emotional mistakes, and that alone creates a massive advantage. But this brings up an important question. If AI is so logical, can it be fully trusted? The answer is more balanced than most people expect. AI is powerful, but it is not perfect. It relies on data. It identifies patterns, but it doesn't fully understand human context, future uncertainty, or unexpected events. It is a tool, not a replacement for thinking, and the smartest investors don't blindly follow AI. They use it to improve their decisions. The real advantage is not choosing between AI and human intuition. It's combining both. AI provides structure, analysis, and objectivity. Humans provide context, adaptability, and judgment. Together, they create a stronger system than either alone. And this is where the future of investing is heading. What this means for you. So what does all of this actually mean for you? It means you don't need to predict the future to invest successfully. You just need to avoid predictable mistakes. And history shows us exactly what those mistakes are. Chasing hype, panicking during downturns, ignoring fundamentals. If you can avoid these, you are already ahead of most investors. This experiment is not about proving that AI is perfect. It's about showing the difference between emotional decisions and logical ones. Because when you remove emotion, patterns become clear. And when patterns become clear, better decisions follow. The past doesn't tell us exactly what will happen next, but it shows us how people behave. And understanding that is one of the most powerful tools in investing. If this breakdown helped you see the market in a completely different way, make sure to like this video and subscribe to the channel. I create content that doesn't just explain money, it helps you understand how to actually think about it. And tell me in the comments, do you think AI would make better investment decisions than humans? Or is human intuition still more powerful? Because the future of investing is not just about money. It's about how you think.